Welcome everyone to today's webinar, How a Financial Institution Looks at Loan Request, presented by Chemung Canal Trust Company. Many thanks to our presenter, Mark Fife, for being with us today, and to all participants who have joined in, and to our educational series sponsor, Chemung Canal Trust Company. Please note this webinar is being recorded to share what we learn with the business community. All attendees will receive the link to the recording. Mark will share his presentation with you, then follow with time for questions and discussion. You can use the chat to submit any questions, or since it's a small group, we can open up the mics. Just a reminder, when others are speaking, please keep your audio on mute to minimize background noise. With that said, I'll turn it over to Mark to start things off.
All right, thanks very much. Today we're going to be talking about types of loans that are available to financial institutions and how they evaluate each type of request. We'll talk a little bit about loan structure, documentation, and time frame. We're also going to talk about how to best present an application for consideration and additional resources that are available to us all to assist in that process. There's a lot of things that are very similar in consumer lending and business lending. One of the things that you may have heard out there over the years is the 5 C's of credit, or the 3 C's of credit. And, in consumer lending, they conduct about the same information. We look at character, credit, capacity, cash flow, conditions, and capital, as well as collateral. Just to kind of briefly refresh everyone's mind on that, character basically means reputation, integrity, your experience, track record, payment history. Those type of things make up what a character is. Your credit, again, goes back to credit history, what your personal and business credit ratings might be, your ability to repay. And if there's any problems with credit, your ability to basically explain what those problems were and how they were resolved. Cash flow is something you've probably heard of, not had a lot of detail with, but that's basically debt service coverage. It's ability to repay a loan from cash. In the business world, that's from operations. In the personal world, it's from your personal wages. Conditions. One of the things we always look at is, what are the conditions facing the borrower? How long have they been employed if it's a consumer? How long has the business been going if it's a business? What's the economy? What's going on in that particular industry? Capital basically talks about resources that are available. What do we have? Do we have the net worth of the owners? Are they willing to guarantee? What's the net worth of the business? How much have they put into the business? We want to make sure that there's what they call skin in the game. And collateral, I think, is pretty much self-explanatory. If you're buying a car, the car is the collateral. But if you're getting a business loan, it can be anything from business assets, accounts receivable, and anything that would be considered a business asset. So that's just a real brief overview of where the 5 C's or the 3 C's of credit are. Now, if you were counting, we actually went through 7 of them. Some of them overlap. Some companies use different ones. Some use 3, some use 5, but those are really the gist of how all credit is evaluated by a bank. When we get into the types of loans, you say, what's the difference between a business loan and a consumer loan? And assuming that most of us have borrowed on a consumer loan, number one, business loans take longer to approve and close. They're usually a lot larger in dollar amount, and they're a lot more scrutinized, I would say. They're fully underwritten, as opposed to sometimes you can go out and get a personal credit card or a personal loan for a car, and they'll just look at your credit score. Business loans take much longer. We actually go through an approval process, which we'll kind of go through down the road here just in a little bit. Costs of a business loan are typically more. Appraisal fees are more, attorney fees are more, document prep fees are more, and commitment fees are more. So people say, why a business loan? Well, they also offer shorter terms. You might be able to get a residential mortgage for your house at 30 years. You're probably looking at a commercial mortgage for 15 years. Now, we can sometimes amortize that, make the payments more palatable, if you will, by doing a longer amortization than the term, but the term was when this thing's going to mature, and we have to figure out what we're going to do going forward. So there's a lot of things that are different from business and consumer loans. We talked a little bit about the similarities with the 5 C's of credit, but there's also some differences. So people say, why would you do a business loan? Well, sometimes you have to do a business loan. If the borrower is in fact a business entity, or the purpose is business related, or if it's a real estate purchase, it's zoned commercially, you're not going to fit into the little boxes under the consumer side. So that's really what we see most of the time on business borrowings. There's a number of different types of businesses that are out there. The simple one is the sole proprietor. And what that means is it's one person doing business as a business name. A partnership basically means that there's two or more. We can get into the details if you have questions as far as general versus limited partnerships and all that type. But realistically, think of a partnership as two or more borrowers. Then you get into the corporations. A lot of corporations, you have limited liability corporations, you have C corporations, you have S corporations. All of these things are available. And one of the things that I always talk to business prospects about is you really need to have three sources available to you. You need to have an attorney who can help you walk through the type of business that you're at. You need to have an accountant who can help you with the financials. And you need to have a banker that you can trust and work through and communicate with to better structure what you're really trying to do. So those are very important. And I talk to all business clients about those three pieces. So the types of loans that we look at is three primarily. A line of credit. So a line of credit is basically set up for working capital. And that basically means that you're taking a product and you're converting it back to cash. So I'll just give you an example of how that works. What it basically means is you're a manufacturer, you build widgets. It costs you raw materials. You have to buy the material to build the widget, and then you have to build it, and you have to sell it, and then you have to get paid. That time frame is the cash cycle. And that's what working capital lines are basically for. From the time that you expend your money to build the widget and the time you get paid, sometimes we need to finance that, and we finance that with a working capital line. Working capital lines are basically for small purchases or lines of credit using accounts receivable as aging. Normally want to be paid off within a year. In the small business world, sometimes the terms are a little bit more attractive. Sometimes they're out there for 3 years. And what that means is every year or every 3 years, it's going to come up for renewal. And of course, we're going to want to see updated financial information to justify the line being either renewed or termed out. So that's the one that we see most of the time. Customers need that. The other type of line that's out there is an equipment line. That would be basically if you were a heavy equipment user and you bought a lot of different equipment, we'd put a line out there. You're automatically approved for it, and the terms would be preset. So if you have a $100,000 working capital line, you could use it to buy equipment. Once you do that, you bring the invoice in, and then we term out that equipment for either 3 years or 5 years or whatever the appropriate term is for that. So those are the types of lines of credit. Term loans are what we see most of the time, and that basically is for startup nature, permanent working capital if you need cash injection to keep the business running while you grow the business. It's for equipment. It's any kind of fixed asset. It also would be considered anything for leasehold or capital improvements. And the term on those normally run 5 to 7 years. If we use SBA, Small Business Administration will sometimes provide a guarantee to the bank. We can extend those terms out to 10 years. What we're talking about here is pretty much across the board in most financial institutions, whether they be a credit union, whether they be a bank, whether they be another bank, a national bank. Most of the information that I'm giving you today is pretty consistent across the board. There'll be variations, but most of the information is pretty consistent. The third type of lending is real estate financing. And as we talked about earlier, on a personal mortgage, you buy a house, we can take it out 30 years, and the rate will be fixed for the 30 years. In the business world, typical, it's a 15-year term, and they'll fix the rate for 5 years, usually tied to some indicator, whether it be the 5-year T-bill is normally where we find most of the small business. There's other indicators that we can use, but most of the time it's tied to the 5-year T-bill. It'll be a margin above that calculation, so that we'll fix you the rate for the first 5 years, whatever it would be today. And as of yesterday, the rate was 5.125 would have been fixed for the first 5 years. Then it would be the 5-year T-bill in our bank, another and 4% over the top of the T-bill. So again, that would be adjusted in year 6 and year 10, okay? Here's where a lot of people get really hung up with commercial financing or small business financing, and that's the documentation. So the documentation is important because the analysis we talked about before and the full underwriting, there's a number of people who are looking at this. And the first thing we need to do is get an application. We're going to need 2 to 3 year business returns of the business. We're going to need 2 to 3 years of personal tax returns. We're going to need a personal financial statement because we expect anybody with a 25% or more ownership in the business will personally guarantee. So that personal financial statement comes in and says, okay, here's what I have as a secondary source of repayment if the business loan doesn't pan out. We're going to need interim financial statements, which means basically we'll say that your year end ends in December and you're coming to me for a loan in August. You know, those financial statements are 8 months old. So we're going to want to see something from June that says, here's what I've done in the last 6 months, just to keep us up to date. We're going to need an invoice and a purchase contract if it's equipment. And we're going to need the organizational documents. Just going back to the type of businesses that are out there, it can be anything from a corporate resolution and corporate and certificate of incorporation, an operating agreement for an LLC, a DBA certificate for an individual, a partnership. All of those things are legal entities to borrow, and we're going to need to see those. The other thing I always ask for is an accounts receivable aging. What that does is tell us who you're selling to, how quickly these people are paying you back, and it gives us a pretty good indication of what your cash needs are going to be and what your cash flow is. The idea of the aging talks about a couple of things. It talks about the customers, but it also talks about the term. So normally terms are set up on a net 30 for companies. If you get into companies that are paying you 90 days and plus, you know, we would need to talk. Now, if it's a medical field and they're insurance agent or insurance companies, you know, that's more typical at 90 days or longer. But realistically, most companies that are manufacturing or retail would normally get paid within 30 days by your customers. So that would be neat. If it's real estate related, we're going to look for what they call a rent roll and copies of leases. Rent roll basically means who is staying in these properties, who is using these properties as commercial real estate, and what kind of lease, how long are they tied into that property. Not knowing what our audience is today, you know, some people want to know what do we do in startup? Well, we start with that information, but you're not going to have 2 to 3 year business returns. So what we're going to ask for a startup is a little different. It's going to be the 2 to 3 year personal tax returns, the personal financial statement, organizational documents, but then we're going to need 3 years business projections. When we say, what's that? Well, what that basically says is looking into the future, what is your expectation of sales and revenue and expenses and net income over the next 3 years? Now, this is one of the reasons I talk about needing an accountant. Now, there are other sources we'll talk about at the end that can help you with this at no charge to help you formulate projections. But those are one of the things we're going to look for startup companies. We're going to need a business plan, same type of thing. Why do you think that your pizza is better than anybody else's pizza if you're a pizza maker? Who is the competition? How are you going to market it? What is your expenses? How much do you know? And it does a couple of things. It makes the prospect or the borrower really take a hard look at, does this business make sense for me? And then it also makes the bank comfortable to say, okay, they've looked at all the opportunities and the things that could blow up, and they've already taken those into consideration. They've mitigated those risks. And so that's what a business plan does. We're going to look for your resume. Had you worked if it's a pizza maker, have you worked in a restaurant before? Do you have experience in management of a restaurant? Have you managed people before? Those are the things that are going to show up on a resume. And the last thing we're going to need on it is what they call an SBA application. It's a Form 1919. You don't need to know that right now, but we will give you that. And that's because most startup companies and most institutions will require an SBA guarantee. And there's nothing to be afraid about an SBA guarantee. What that really does is it guarantees a portion of the loan to the bank in case of default. And that percentage can be anywhere from 50% to 85 to 90%, depending on the product that we're talking about. Don't need to get involved with that, just need to know the terminology that says that's what SBA will do for you. So, so the way to present an application to the bank is with that information that we talked about, what they call a complete package. I would encourage you to probably either type that information or neatly write it, print it, whatever. Talk about your business plan or be able to talk verbally with your banker about what you're doing and what the impact of the use of those funds are. What do you need the money for? Are you buying a piece of equipment? Are you starting a new business? What do you need the funds for, and be able to explain to them why? And the banker will walk you through that process. That's not a big deal. We'll say, okay, I want to do this. And they'll say, okay, what are you going to do with the funds? How is that going to help your business? Does a second pizza oven make sense? Are you at full capacity at this point? Those are questions that you're going to hear when you talk to a banker. Be prepared to talk about the business itself, your history and background. And what I normally do, in case you've ever gone out on a call with me, I'll normally go to the business owner and say, tell me a little bit about your business. And then I shut up, because realistically, people love to talk about their business, their dreams. This is what they really want to do. And by getting that information, you're getting it firsthand, how involved they're going to be, how passionate they are about this business, and realistically, what their expectations are. So I normally will ask that question. So don't be surprised if a banker asks you, tell me a little bit about your business, and ask for a tour of that business. You can learn an awful lot by walking around the business to see what it looks like. And so that's kind of how the applications would come. Most institutions will look for a relationship when doing loans. They're not going to look just to do this one-time loan. They're going to ask you about your deposit relationship. They're going to ask you about, do you use merchant services? That means, do you take credit cards? Most institutions offer that product and service as well. What about your personal accounts? Do you bank here? That all lends credibility to the loan application. Not required always, but it is a nice thing to have. So that kind of gives you just a real quick background. I want to talk to you just a few minutes about the analysis that's involved with it. And then I'll go through the textbook explanation of where we go. But realistically, what we look at under analysis is the first thing we look at is debt to income. So debt to income is a percentage of your income against your debt. And the reason we look at that is we look at cash flow as the primary source of repayment of any loan. So whether it be a personal loan that you're buying a car, or whether it be a business loan, you're buying a piece of equipment, cash flow is what's going to make that loan. So the first thing we look at is cash flow. And we look at it a couple of different ways. We look at what they call debt service coverage ratio. And we talked a little bit about that. That's total income less a percentage for personal expenses divided by total debt. And again, you don't need to know the ratios, but you need to understand how banks look at these things so you can better prepare for the conversation when you go out. We look at credit history. So if it's a new business or even an old business, we're looking at the guarantors. If you're a 25% owner, you're going to personally guarantee. And so we're going to look at your personal credit history. When we say, Mark, why would you do that? Well, that's also a source of repayment in case cash flow doesn't work. So you buy this piece of equipment and the business fails. Well, we got a piece of equipment we got to sell. Well, we're going to sell it probably less than you owe. So now what am I going to do? I'm going to look at you to make up the difference. So we look at your personal history sheet, personal financial statement, as well as your previous credit history. That's a pretty good indication of how important credit is to you. Typical credit score in the business world is probably minimum would be 650 to 700, as opposed to a maximum of 850. So you can have a personal credit score up to 850. We're looking for people to be someplace in most institutions between 650 and 700. There are times that we'll look at less than 650, but realistically, that's kind of the threshold that most institutions are looking at. Collateral and equity. The reason we want to know that is, again, it's against loan to value. You bought that piece of equipment, you paid all of the cost for it. It was $50,000. You had to pay tax on it at 8% plus delivery fees. Now all of a sudden you're into this thing for, $60,000, $50,000, $55,000. If for some reason the company doesn't make it and we have to foreclose or close it on the business, we're not going to be able to get $55,000 out of that piece of equipment. So we're looking for you to put someplace between 10 and 20% down on that equipment. So we'd be looking at a $50,000, put a minimum of $5,000 in on it, which basically covers the carrying costs and, go forward from there. So that's kind of the analysis that we do through this. So we say, what if I fall short in those areas? What if I don't have the money for the down payment? What can we do? Well, banks work with a lot of different institutions, and I'll go through a couple of them here. The Small Business Administration we talked about, which guarantees a percentage of the loan to the bank in case of default. REDEC, which is Regional Economic Development Company. They'll come in, or in economic development agencies, they'll provide what they call gap financing. So we'll say that I ask for 10% of that 50,000, and you don't have it, but you got some. We can go to REDEC or other agencies and get what they call gap financing. And what that basically means is they will take a subordinate position behind us. So I'll take a first lien on that piece of equipment. They'll take a second lien and they'll give you the money to make up the difference, that additional up to 10%. So if I'm asking for $10,000 down, you only have 5, we'll go to these guys, they'll give you the 5 and they'll take a subordinate position. They'll be behind the bank. So there's lots of ways that we can work with that. There's other things that are out there. Typically, we look for 20 to 25% down on commercial real estate. We also partner with Pursuit, which is a SBA 504 program, which reduces your requirement down to 10% of the total project, not just 10% of the purchase, but all the closing costs, all of the build out, everything else. So those are things that I don't expect in a half an hour presentation we're going to get through a lot of the detail, but just know that your banker should know about these products because they're going to help you and when you go to look at it. So just in finishing up, and again, I see we're almost out of time, but we'll leave time for questions, is that we look at the process, and that's really where the rubber hits the road. The textbook answer for the process is I just want to pull the textbook. Hold on a second. The textbook says you assess the opportunity first as a banker. Then you do a preliminary analysis. You do a repayment source analysis. You package the loan, and then you manage the loan. So that's the textbook answer. We can go through all of those individual lines and figure that all out. Really what it comes down to is we meet with you, the prospect, for the loan. We discuss the initial request. Does it make sense? Are the terms reasonable? Does the cash flow on the front side just look okay? How about the collateral valuation? What are you buying? How much are you putting down? Then we try to structure the loan. I say, okay, we're buying a piece of equipment. What's the useful life of that equipment? Well, if it's a printing press, it might be 15 years. If it's a computer, it might be a year, but we would say 5 years, right? So what we would do is try to match the terms. So if you're buying a computer, we're probably going to put it at 5 years max. If you're buying a press, we're looking at probably 10 or 15 years that we could actually finance that piece of equipment. we look at the initial cash flow. We look at the debt service coverage ratio. Again, we talked about that. That's your income compared to your expenses. We evaluate the collateral position. Is this a new piece of equipment? Is this a used piece of equipment? What's the useful life of that? What do we do with it then? How do we determine the value? If it's new equipment, we have an invoice. If it's used equipment, we have to go just by experience or go to the auction houses to see what it's worth or get what they call a desktop appraisal. I was doing a dump truck loan last week, and it was a used dump truck. Well, very difficult to find the value of a used dump truck, diesel, don't know if the engine's been rebuilt, with 250,000 miles. Well, we had to do a little research to find out what the valuation was. We knew what he was selling it for, but we had to find out what the valuation was at the end to protect, both the customer and the bank in that case. So once we get through all of that, the banker will do what they call a write-up or a history or a call report and kind of just summarize what the conversation was all about. And that's an internal piece that we use when we go to underwriting or we go to a loan committee that says, here's what we're doing. Then we put the package together, which for full underwriting, which is reviewed for any policy exceptions. It would be, what if there's a policy exception, something we can't do, but we want to do it, we can do it. We just have to have that listed as a policy exception. We pull credit. Again, why is credit important? Because we're looking at that as a secondary source of repayment. We look at additional information on the request, and we package the loan request for approval. Then the decision's made. We do one of three things. It's either approved, it's declined, or it's conditionally approved. So it might say that we have a policy exception for 10 years. We only want to go 7. Okay, so I call the customer and say, look, we got you approved, but we can only go 7 years. Does that sound reasonable to you? Next thing we do is we close the loan and fund the loan. So the ongoing thing that we look at in these things is, how we want to make sure that you're successful. Last thing we want to do is have you not be able to make the loan. And that's really what it comes down to. We're trying to help you be successful in your business. Now, I ran through that very, very quickly, and I apologize for that, but I looked at the time and said, I think we're almost out. But I do want to allow time for any questions that anybody might have, or if there's things that you need clarification on, I'd be happy to try to clarify that for you.
I don't have any questions. That was very thorough. And as far as the computer lifespan, I wish we could convince boards that it's not 10, 20 years for computers.
That's exactly right.
Ron, do you have any questions?
I just unmuted myself. Well, I'm not necessarily the audience that you wanted and stuff like that. I do got some questions for you. I don't know if you want to decide you want to edit off the one, but to me, this is a perfect one to give to SCORE clients on there. And now that the Southern Tier SCORE has merged with Central New York and Utica, there's a much bigger audience that I think overlaps the Chemung Canal footprint even more, maybe.
Sure. Yeah.
And I know they just put a request out for more people wanting to do webinars for them. So if you want, I will give them your name on that. But I did have 5 questions or clarifications.
Sure.
On there. You mentioned for the what would you call it? Line of credit financing for like equipment. You didn't mention rentals for like, heavy equipment. Is that available for renting? Let's say you're a contractor and you need to get a lift or something like that.
Yeah, we would consider that. We consider that part of the line of credit that you would do if you're going to rent it from a company for 2 weeks or so and pay it back. Yeah, that would be fine. Again, that falls under the working capital. If you're going to long-term lease a product, Ron, we do offer a lease program as well. So some accountants will recommend rather than buy a piece of equipment, you lease it. We offer that as well. But in your question, if you're looking to just temporarily use a piece of equipment and then pay it back, yeah, that's part of working capital. We could do that as a line. Yep.
And you just answered my question on leasing, because I have referred people to leasing companies, but you do equipment leasing also.
We do. We have a leasing company that we work with. Yep. Yep.
Okay,
And it goes through our approval process too, Ron, just
of
so you know.
course.
Yep.
The other one, I personally came in conversation with one of my clients a year ago. It was a startup business acquiring land, campground, etc. Not it wasn't used as camping, but they were repurposing all of it for what would you call it?
Development?
Not development in the sense of housing development or manufacturing. They were going to do, and I have to follow up with them, me being a snowbird, and they haven't communicated with me in a while, so I have no idea if this got off the ground or not, but the business plan was well done. It was around 45 pages.
Okay.
A lot of research, these guys, but it was for what would you call it? Rental of and fishing expeditions and hunting expeditions and renting and parties, you know,
Okay.
on there. They're very encompassing, but they were acquiring land in the facilities, which were amounting to, if I recall, over $1 million. What percentage of that is equity? Like in a house, you know, if I'm buying a house, you're financing the whole thing, you know, pretty much minus maybe 10%, 20%, something like that. In
Absolutely.
commercial real estate, what's the
Okay.
ratio there?
So commercial real estate was a little bit different. So let me start with it. The loan to value piece would be normally someplace between 75 and 80%, except for undeveloped land. So the land you're talking about, we'd be looking at 50%, okay?
Okay.
Not a huge appetite for undeveloped land. There's quite a bit of risk involved with that in case of default. What we look at in a lot of those cases, Ron, would be to say, what's the strength of the guarantor? Do they have something else that they could pledge to make up the shortfall? How can we work around that? What's the structure? So you said there's a couple of structures on there. The way we work that would be, we would do the appraisal or purchase price, whichever is less. So that 75 or 80% that we look at on the structure is based on the purchase price or appraisal, whichever is less. So for instance, if it's $100,000 purchase of a commercial piece of property and the appraisal comes in at 90, our 75 or 80% is based on the 90. The customer has to come up with the other $10,000 because we use whatever is less. Because, and if it's the other way, you know, it still doesn't matter because we'll say that same instance, it's $100,000, the appraisal comes in at 120, we're still going to look at the $100,000 on there. So real estate's a little tricky. Yeah, but good question, really good question.
The curiosity, when I was in business, we had our first loan SBA guaranteed, but none of the others were. I mean, we were then becoming a real proven business over
Right.
30, 40 years. Does guaranteeing it with the SBA, does that increase the interest cost to the
No,
consumer?
no. The only fees that might be involved in that, Ron, would be the guarantee fees. So sometimes they'll charge a guarantee fee depending on what type of debt it is, whether it be a 7A or a 504 or an express. And normally up to a certain dollar amount, there's not even a guarantee fee. So on the small business side, which we have a lot in this market, you know, under $500,000, basically we can put an SBA Express on pretty much everything. And if there's a guarantee fee, it's very, very minimal. And what it does is it doesn't make a bad loan good, but what it does do is makes it a better appetite for the bank to look at it because, you know, it might be a risky entity, for instance. So if that's why I said with a startup, we normally look at SBA. Certain industries, bars, restaurants, we typically look at SBA because there's a certain amount of percentage of failure in those industries.
No, industries are marked. I understand that. I do some financing in Florida for a business that is not rated. Their industry is not rated great, so I can come in under the bank and still make some money.
Sure. And that's good.
Does it, especially in the small business market, does it pay for someone to shop around to find a bank that maybe specializes in this area?
Oh, it does.
Field?
Yeah, you know, it never hurts to shop. I never discourage people from shopping. I think, like I said, part of the thing is most people shop on rate. What they don't shop on is expertise. And I've had people come to me, you know, and again, I've been doing this a few years. I've had people come to me and say, we'll talk about, for instance, a 504. You know, their banker didn't talk to them about it. And they said, well, you know, why didn't they? I said, they may not know about it. They may have never done it. It might be something new to them. But yes, it never hurts to shop both rate and appetite for different types of lending. And the banker really should be able to tell you right up front what their appetite for this. I try to. If somebody calls me and says, you know, I want 80% financing on a piece of real estate that's undeveloped, going back to your story, you know, I would just say that, you know, our policy says 50%. We would have to really be creative to come up with that additional money.
Okay, that's my list of questions for
Great.
small businesses.
All right.
I get large questions answered by my son, who's who works for M&T or Wilmington Trust, even the higher
There you
end
go.
down in
Okay.
the city. So it's
Yeah.
he tells me some stories of financing, you know, multi-million-dollar deals. Creatively.
Well, and we've done those. I was with HSBC prior to Chemung Canal before they sold the upstate market. And yeah, we had some stories, that's for sure.
No, very good. No, I will contact, or I'll send over to you the maybe the email from the lady that's in charge of the webinars for SCORE. And
Fine.
you may want to put yourself and the bank in play there.
Absolutely.
Because at least the ones I do in the West Palm market when I'm down in Florida, they're pretty well attended. I usually get a dozen people or more on a webinar on the
Yeah.
ones that I do.
Right.
And so, you know, this is now being a really pretty big area now, the SCORE is doing, and your footprint is fairly large.
Right.
I think it'd be a plus for you guys to do that.
More-
And, you know, the chamber is the key a lot of times working with on it. And we thank the chamber for
Absolutely.
hosting these things.
Yeah, more than happy to get the word out, you know, to anyone or any group that would feel beneficial. Chemung Canal wants to be that community partner, and we have been for a number of years. So I think it's good to get that out, and I'm available anytime to anybody. If they want to give me a call, just, you know, feel free. So, okay.
Wonderful.
Thank you for your time.
Thank you.
All right,
Beth,
great.
anything else?
Nothing for me.
Okay.
All right, thank you, everyone. We will share the link to the recording with attendees and on our YouTube page. You can also visit chemungchamber.org to register for upcoming webinars or find recordings of previous webinars. Many thanks to Mark and to everyone for joining us today. Have a great day.
Thanks much. Have a great one.